Welcome to The Point of View. This is your favorite current affairs show on television. We bring you the right topics, we get the right guests and ask them relevant questions on issues that matter to you. Ghana's economy is back in focus and we are going through a very difficult time. Three important rates. Inflation rate is around 25%. That's serious. The exchange rate is also very serious because the Ghana cedi is buying the dollar at 15 cedis on the forex market. And of course, a couple of days ago, we were also told that the APRs of banks ranges between 30 to 50%. So some banks are giving credit to businesses and individuals at 50%. How did we get here? We'll be discussing this from three perspectives. We're speaking to an economist, a banker, and a lawyer for three angles to the same problem. Stay with us. Welcome back. So tonight I'll be speaking to Professor William Barboateng. He's an economist, head of Department of Economics, University of Ghana. He will be answering questions on the relationship between the three: interest rates, inflation, and the exchange rate. He also proposed some solutions for the overall macroeconomy. We'll speak to Dr. Richmond Etuahene. He's a banking and finance analyst. He's written about these matters as well. He's coming from a banking perspective. What role does the banking sector have to play in this economic challenge we face, and are the banks victims or villains in the current economic challenge? Then we are bringing a lawyer for the first time into this macroeconomic discussion. Jonathan Amable is a private legal practitioner and is actually at the Supreme Court seeking some reliefs which he believes will help give Ghana better macroeconomic management. So those are the issues we'll be discussing. Let me first welcome all three guests. Professor Barboateng, good evening. Thanks for joining us. Dr. Etuahene, good to have you. Good evening.
Good evening, Bernard. How are you?
I'm very well, thank you. And then Mr. Amable, thanks for joining us for the first time on The Point of View.
Hi, Bernard. Good evening. Thank you.
Wonderful. Prof, let's start with you. Inflation was at 54% in 2022. It's come down to around 25%, which is still pretty high. That notwithstanding, interest rates are not coming down. The last time we checked, the policy rate is about 30%. APRs of banks is between 30 to 50%. As for the exchange rate, we know it already. We are buying the dollar for 15 cedis on the forex market. So what is the relation between these three rates, and why is inflation coming down, but these two other rates are not coming down? Prof.
Okay, thank you very much. I will leave the determination of the lending rate. Interest rate, there are so many things that go into it. And when you say interest rate, we have different types. You've spoken about the policy rate. We also have lending rate. We have deposit rate, and so on. So those that are mostly finance, I will leave it to Dr. Etuahene to look at it, because before banks determine their interest rate, they have the base rates, they have the credit risk, and many other factors that they consider. But if you look at the three variables, I may call it trinity: interest rate, exchange rate, and inflation. They have relationships. So I will take them one after the other. So I will start with interest rate and exchange rate. We all know exchange rate is supposed to be the relation between country's currency and the currency of other countries. So when interest rate goes up, under normal circumstances, and here I'm talking about if the economy is normal, there's no problem in the economy. Ghana's economy is challenged, so we cannot put it in that perspective. But if everything is normal, when interest rate increases relative to foreign interest rate, it attracts foreign capital. Foreign capital in a form of foreigners coming to hold assets in domestic currency. And it also attracts foreign direct investment. And here you are assuming that everything is fine. There's political stability, business environment is conducive, taxes are not killing people, everything is perfect. So in that case, you expect an inflow of foreign currency. So if interest rate increases and relative to foreign interest rate, it strengthens one's currency. So that is the relationship. However, we are not having this situation because we are not in normal times. Now we've been shut from the investment and financial market. That is for, Eurobond and so on. So even if you raise your interest rate, you don't expect investment or people to come and foreigners to come and hold your domestic assets. Apart from that, our business environment is not conducive, as it were, and if the report that we are hearing is anything to go by, now you have foreign companies even exiting. Therefore, even if you raise your interest rate, it still doesn't attract foreign investment because the environment is not so good for them to come and invest. So that is why you may have interest rate going up, and then you also have interest rate, exchange rate also up. Another dimension which is peculiar to Ghana is that in our foreign exchange market is quite liberalized, and people can hold foreign currency. So if interest rate increases, what you expect is that you divert those who are holding foreign currency, or those who are even holding domestic currency and trying to diversify their portfolio, divert their attention to put their money in savings. So for instance, if the exchange rate was 12 cedis to $1 in January, and it's now 15 cedis, so it means that an increase of 3 cedis. So 3 over 12 times 100 gives you 25%. Now, if interest rates in Ghana, let's say the TB rate or fixed deposit rate or any investment can give you something which is more than 25% in 3 months, then you'll be able to divert those who are holding on to excess liquidity, domestic currency, to go and save. But if the interest rate, the rate of increase of interest rate is lower than the depreciation of the cedi, because people want to make sure that they maintain the value of their currency, they will go for foreign currency as a store of value. Now, so if you do the math, you see that the rate of depreciation of the exchange rate, and here I'm using the price quotation for simplicity sake, you have about 25%. So if interest rate is 50% per annum, and you divide it by 4, so you are talking about 12%. So even for 3 months, an interest rate is lower than the rate of the exchange rate. So individuals who are holding excess liquidity, domestic currency, may want to buy more dollars because the system actually allows that. Then we have interest rates and inflation. And this one, you can look at it from 2 angles, from the demand side and from the supply side. From the demand side, when there's excess liquidity in the system, which the central bank had made us know that there's excess liquidity in the system because they have the numbers, it increases demand. And therefore, if output is not able to rise to meet the increased demand, it causes inflation. And therefore, the central bank may want to mop up that excess liquidity by increasing the interest rate so that we'll be able to tame demand and bring down the interest rate. On the other hand, when interest rate increases, it also increases cost of capital, and for that matter, cost of production. So it also brings about an increase in prices. So while the demand side will try to bring down prices, the supply side will also push up prices. And therefore, you normally have to look at the source of inflation when you want to address inflation, and that will tell you which one you need to look at.
Okay, Prof.
And you need to also be told by the data.
Prof, thank you for the beautiful analysis. So which of these 3 is the most important or the leading one? Which of them determines what? Between inflation, interest rate, and exchange rate, which of them is like the lead or driver indicator of the 3?
From where I sit, I can tell you is the exchange rate. So because I was going to talk about exchange rate and prices, where we have the exchange rate pass through. And as an import-dependent economy, whenever the exchange rate depreciates, it reflects on general price of goods and services, especially imported goods. Apart from that, when the exchange rate depreciates, we also import capital goods, intermediate goods as well. And that also feeds into cost of production domestically and also raises prices. So the driver of all these is, for me, is the exchange rate, especially where we find ourselves as a country.
Let me pause with you and come to Dr. Etuahene, because you said that he would deal with the specific rates. And thank you for the differentiation between general interest rates and then specific interest rates. So we have, for example, the deposit interest rate. We have even what they call the APR, which is what the lending to end user consumers are, and also the policy rate. Doc, what are your thoughts around the relationship between these interest rates and the exchange rate? Because as we speak, the BOG doctor tells us that banks are lending to customers between 30 to 50%. That's pretty high. What is behind these large numbers, and what can you say? What can you say to explain these high numbers?
Thank you very much, Bernard, and thank you, thank Prof, for giving us the brilliant overview. But to add a little bit to Prof, you know, the way where we have find ourselves with inflation, it is all about deficit financing by central bank. It is clear. It's clear, because other than that, the IMF team would not have told us to do zero financing. And I want to give some figures to buttress my point. In the year 2020, we overspent by 15.2%. 2021, we went up to 12.3% GDP, fiscal deficit. And then 2022, I think it's 11.3. The current provisional figure tells us that 2023 was 7.3. And if you ask yourself, how have we financed all this deficit? The literature says that should the central bank finance government deficit, we then head for inflation. It is one thing that we should get declared. So part of the inflation that we are fighting currently, it emanates from the financing of our fiscal deficit. Clear, there is a literature there. And again, if you have to fight inflation with inflation targeting, which Bank of Ghana has been using us since 2007. If you read the literature, there hasn't been any time we managed to come into the band 8%, 8 minus or 2%, plus 2% or minus 2. We haven't. The reason being is that most of our inflation are cost-based, cost-push inflation. Because as Prof said, we do import so much that we import all these problems into our system. So if you want to fight inflation and you're just using inflation targeting, which is based on the demand pool, then you leave the cost pool, you're always going to have this type of inflation in your economy. That is number one. Now, Prof said something which is very interesting. He said that as people would weigh the pros and cons of the asset that you have to hold. But empirical evidence, starting from 2020 to 2012 up to now, anytime we are in election period, what happens is that people are not sure and confident of what is going to happen. So definitely, as a prudent investors, they will come out from the CD bills and go and get dollar. And this have accelerated the rate of the dollar. In addition to the demand of the multinationals, like MTN recently declared a dividend and he's paying so much. Stanbic did the same thing. All the Nigerian banks. Don't forget, all these people who came in now demanding foreign exchange to come and pay their dividend through their countries. All these things have accelerated the depreciation of the currency. In addition to what we have, the commodity dependency and lack of export diversification over the years. These are the things that we have to face it, as Prof said. We need to face it up. Hello, higher interest rate and the correlation between the higher interest rate and the banks.
Yes.
Don't forget that the policy rate is the base for which all these APRs and the bank's inheritance risk, customer levels, and all these things, pricing of cost, are added to it. So once you have a higher policy rate, which is taming inflation, definitely the interest rate would have to go up. That is why you find what you're saying, some are charging 30%, some are charging 20%, some are charging 40%. It's all because that the where we start from our interest rate calculation, currently the policy rate is 29%, and 29% and over and thereabout. No bank can price its asset lower than the policy rate because he hasn't included the risk premium, the sector premium. All these things will be compounded, and because of that, we will have a higher interest rate. And the sad thing about this higher interest rate we are talking about, it has a direct correlation with the higher non-performing on the economy. If you do a research, which I have done a research, since 2014 up to 2023, our non-performing has ranged hovered between 11% and 25% or 24.9%. It's all because the microeconomic environment, of which interest rate is a factor, into which the currency is a factor, of which the policy rate is a factor, are not on the right tangent. And when they are not on the right tangent, what happens is that customers will take the loan, hoping and praying they can come and pay. But as they go to work, they realize that these things do not work as it is, and it translates into higher non-performing. And Bernard, the frightening thing, which I want to tell Ghanaians, is that recently, 2022, global data on NPL, let me tell you, Ghana is fourth.
Wow.
We have Ukraine, 38%. We have Guinea-Bissau, 55%. And then we have, I think, Chad, 27%. And then you come to Ghana with 15%.
Are you serious? So the whole...
I'm very serious. I have the data.
The whole world for 2023.
The whole world, Ghana was on the 4th, 2022. I'm sure 2023, we might even come second.
Serious?
Our banking sector, I want to say this without fear of favor. People say that our banking sector is resilient. I want to check them clearly. From the literature by Dietrich Kuntz and Dimak in 1988, officers at the IMF, says that any country whose non-performing exceed 10%, your country is in what you call fully fledged crisis. That is what the word they use. So when I hear about this banking non-performing in the economy, seriously, we need to work on the economy so that we will leave this table. This table, we are on the 4th. I'll send you the data to you tomorrow.
All right.
I'll send the data to you. And it's so frightening.
Let me ask one quick question around the banking and then wrap up on the economic side. Are the banks victims of the situation we are describing or the cause? Because I've heard people say that our banking sector is the most profitable. The spreads in our deposit and lending interest rates are high, and therefore Ghana's banking sector is very profitable at the expense of the real economy. So in that sense, they say the banking sector are actually part of the problem. But you also talk about deficit financing and crowding out by the government, which suggests that the government could be the cause. So if I were to push you to give a tag to the financial institutions, are they more on the victim side or the villain side?
Thank you very much once again. I think if you throw the coin, it could be 70-30. The reason being is that there are three determinants in the level of non-performing in a country. We have the macroeconomic instability, which we have already dealt with.
No, you mean macro, not micro.
Macro, the macroeconomic, inflation, interest rate, what have you.
Macro, yes.
And then you go to the bank specifics. The bank specific is that some of the banks go into certain areas which they have limited minds. They don't understand their inherent credit risk. And let me give you one typical example. And I want my professor he is a professor, so he will tell me. Have you seen any bank in a part of the world where they will choose to buy government bonds to a tune of 9 billion against a loan portfolio of 7 billion? Because they thought government bonds were risk-free. So when they did a DDEP, they suffered so much that recently they had to go to the stock exchange to look for capital. The banks are also part of the problem because their risk analysis, credit risk analysis, is a bit porous. Because you see, you go to a sector. Let me say one bank, I won't mention their name. they finance contractors to a tune of 2.1 billion. I asked them how many experts in road construction and engineers do you have in your office? They don't have anybody. So people come and say, oh, we have road, oh, help us, and then they go in. But if you're a serious bank like those in overseas, if you want to go there is a specialized unit who will handle it. Unfortunately, that is why you asked me whether they are victims. Part of the problem is inherent. It's from the bank themselves. That is why when you say the banking sector is not resilient, we can split the banks. I can split it for you. The foreign-based banks are more resilient, whereas the domestic, what we call the private domestic bank, including the state-owned banks, are not resilient.
All right.
Because they go into the sectors without even understanding what is there for them. So that is what we call the specifics. Now let me go to the industrial specific. If you have a case, if you have a credit case from the bank and you go to court, it can take you as long as 10 years. Even with the passage of the Borrowers and Lenders Act 1055 recent, they still don't give you power of sale when people default on your property. You have to go through the court process. And the more you delay, the more that is why I'm saying that the factors are specific, bank specifics and industrial specific and the macroeconomic specifics. So that is what I will say, Bernard, for the time.
Let me take a quick comment on this from Professor Babuatin. Prof, so he's explained the banking side, but two issues come up for me. Ghana's high MPLs, fourth in the world, according to his data. And also, what do you and I know as Ghana's large interest rate spreads? Because I've interviewed you on this before, where in Africa, our interest rate spreads are among the highest. Is it the government macro that's making our banks this inefficient? Or is it the bank's inefficiency that's helping to make our macro confusing? Prof. Babuatin.
Well, Ben, I was tempted to say it's chicken and egg, but from where I sit and a little that I have read, I think the banking challenges emanate from the macroeconomic challenges, which also emanate from the fiscal challenges. And if I can, if you allow me, I can say that almost every problem that we are encountering, whether it is monetary, whether it's banking, whether it is exchange rate, it emanates from the fiscal side of government. Why is it so? Of course, the banks are there to make profit, and therefore, if they realize that inflation is eating up their monies, they will spread it wide so that they will not lose. So you expect they will do it. So when we have the spread, it is based on the macro environment. If the macro environment is so stable, such that inflation is within the single digit, it helps banks to plan. They don't have any uncertainty ahead of them, and therefore you can't blame them for having that spread. But the point is that our fiscal management has been the bane of our economic challenges, and it even becomes worse when we only look at expenditure and revenue. And Dr. Chahina was talking about 15% and so on. In economics, fiscal deficit is not bad in itself. And I think I need to emphasize that. It's not bad in itself, but how the fiscal deficit is created. We are in a country where expenditure are based on unproductive kind of expenditure. We are in a country where procurement, overvaluation of, if I can say over invoicing, or the value of a project that is supposed to be 100 cities is supposed to be given out as 1,000 cities, sometimes 10%. And the 900 or the 900, which is in excess of the 100, is coming out without any productive activity backing that money. In economics, money is nothing if it is not backed by production. And therefore, if government has a project, let's say government is buying a car, and the car costs 100 cities. Government expects that that car will work and bring at least 100 cities or at most 200 cities. So that means that if you add everything to it, it's about 200 cedis. But the car was bought at 500 or 600. So the value of the car is between 100 and 200, but we paid as much as 500 or 600. That difference is going into somebody's pocket without working for it. And that kind of excess liquidity will come into the system, and then it will affect the banking system. It will affect the interest rate. It will affect everything. And therefore, the central bank then comes in to clean up. And central bank cannot continue to clean up. And that is why if the interest rate is so high, it also hurts businesses.
Thank you, Prof. We'll pause here and come back after a break. This is the point of view. Tonight, we are looking at Ghana's galloping rates, interest rates, exchange rates, and inflation rates from three perspectives. We have an economist, Professor William Babu-Ateng. We have a banker, Dr. Richmond Etuahene. We also have a lawyer, Jonathan Amable. And when we come back, we'll deal with the issue of regulation, because one way the government has sought to finance the deficit has been to borrow short-term instruments known as treasury bills. Now, it is the lawyer's contention that if we had stricter regulatory enforcement by Parliament, some of the holes we are seeing in our economy would not be created. We'll deal with that and more when we come back. Stay with us. Welcome back to The Point of View. Tonight, we're looking at the economy. Exchange rates, 15 cedis to the dollar. Interest rates, the APR, annualized percentage rate, between 30 to 50% to credit for credit to private sector, and of course inflation rate over 25%. We have Dr. Richmond Etuahene, who is a banker, Professor William Babu-Ateng, an economist. Let me come to Jonathan Amable, a private legal practitioner. Jonathan, one of the things I need to say, and thanks for joining us, is the government has tried to raise money because obviously it needs to finance its activities. And in 2023, close to 50 billion cedis was raised through the sale of treasury bills, which we know as short-term instruments. Now, whereas foreign lendings or foreign borrowings are regulated by Parliament, this does not go through Parliament. Why is this a concern for you, and why do you think this is contributing to the large rates we're finding in Ghana?
All right, thank you, Bernard. So I think to set matters in perspective, we are looking at the legal framework. In all the things that your hosts have, your guests have said, I've heard a lot of complaints, and mainly has to do with the fiscals. It has to do with deficit financing. So in order to address these issues, we need to look at the legal framework that regulates government financing generally. And the Constitution sets the tone for that, because a misconception is that the Constitution under Article 181 only deals with international matters, but the real aim of Article 181 is to regulate government borrowing and government giving out of loans generally. And you would notice from the time this law was introduced in the 1969 Constitution, the aim for the introduction was really to regulate the government's ability to give out loans, the government's ability to take loans. And this restriction was then made to apply to international business agreements. So the main heading, if you look at Article 181, is loans. And when you look at 181.3, it's quite clear that the government shall not raise any loan otherwise than under the authority of an act of Parliament. And then when you go to Article 181.4, it tells you that this act of Parliament, which is enacted to enable the government to raise loans, must state clearly that the terms and conditions of the loan shall not come into effect until they have been laid before Parliament and approved by a resolution of Parliament. And then one may ask, so when we are looking at these things, what we are talking about, we are talking about treasury bonds, okay, we are talking about treasury bills, we are talking about instruments issued by the government to the Bank of Ghana to raise financing, because the guests were talking about central bank financing as well. You realize, you wonder, do these things qualify as loans? When you look at Article 181.6, again, the Constitution is quite clear. It says that a loan is any money which is lent to the government on condition of return or repayment. and any other form of borrowing or lending in respect of which money from the consolidated fund or money from any other public fund would be used for repayment. So when you look at the Constitution, you see that quite clearly under Article 181, the Constitution contemplates that the government must have a certain level of control. There should be a certain level of control over the government's financing, and that is done through parliamentary approval of the specific terms of all types of loan transactions, be they the regular loan transactions that we see go to Parliament all the time, or treasury bonds, or treasury bills, or central bank financing. Now, this is the constitutional framework. So you can go from there to the legislative framework. What is the legislative framework? The government borrows under the Public Financial Management Act. And when you look at that act, it's also quite clear. It puts things like the T-bills and other stuff, the treasury bonds, within the framework of borrowing. So the Public Financial Management Act is quite clear that those things constitute borrowing. Unfortunately, when you realize that the Public Financial Management Act requires parliamentary approval of all the other types of borrowing, but then when it comes to the issuance of these treasury bills and bonds, it fails to repeat this constitutional requirement that the borrowing.
So Mr. Amabile, to help our viewers, let me read the specific Financial Management Act for your comment. So if you look at Section 61 and to 64 of the Public Financial Management Act, it talks about issuance of government debt securities in the domestic market. Now, that appears to have been given a different treatment than other forms of government borrowing. So, for example, 61(1) of the Public Financial Management Act says, the issuance of government debt securities in the domestic market, emphasis domestic market, shall be by way of auction or any other method approved by the minister. 61(2), for the purpose of subsection 1, the minister shall by regulations or rules or guidelines published in the Gazette regulate the format of and criteria for the auction and the procedures for participation, bidding and allocation in auctions. There is no mention of Parliament here. Again, when you come to 64, in fact 63, which is borrowing from banks and other financial institutions, it is clearly mentioning Parliament under subsection A, subject to terms and conditions approved by Parliament. So some would say that it is for possibly good reason that the framers of the law differentiated between a government debt and domestic debt bond from other forms of borrowing. What's your comment?
So once you start from the right point for the beginning of this analysis, which is the Constitution, you realize that the Public Financial Management Act in these provisions is only given effect to Article 1814. Now, the Public Financial Management Act in itself has recognized that the issuance of these debt securities is a form of government borrowing. It clearly recognizes that. So once you have all these things quite clear, then you realize that it can only be an error that government securities which are issued domestically are not subjected to the requirements for parliamentary approval, whilst government securities which are issued internationally are subjected to parliamentary approval. I think that the reason for that distinction is because people tend to think that the focus is on the focus of Article 181 is on international transactions, when the actual focus is on loans. And once you have that perspective, it's quite clear that all these are covered. So the Public Financial Management Act is one way of looking at it. Then you also have the Bank of Ghana Act, which also enables the Bank of Ghana to lend money to the government. And to the extent that the Bank of Ghana Act enables the Bank of Ghana to lend money to the government, again, the constitutional requirements of Article 181 and 3 are very clear, and they should be respected. But then you realize that, again, there is no requirement for Parliament to approve the terms of any loan that is taken by the government from the Bank of Ghana. And when you read the IMF report, I think they are quite clear that central bank financing of the national budget contributed to a large extent to the inflation that we experienced in 2022, which we are still recovering from. So when these things are looked at clearly, you see that the framework which was actually set out to regulate government borrowing was done such that if it's to run properly, you could have a situation where there will be an external control on how government borrows money, which then creates an external control on how government spends money. And this issue of the fiscals will then be resolved. But now you have a situation where the government is its own master in terms of how much it wants to borrow, what is the interest rate at which it borrows, and how does it conduct its borrowing. And it does that without recourse to any external lever. And that, I think, is a legal and regulatory way through which these issues such as high inflation rate and other macroeconomic problems we're experiencing can be looked at.
So if I get you right, because the economists are even telling us that the fiscal side tends to dominate the monetary side, whether it's inflation or any other policy, unbridled fiscal expenditure can damage the economy. That's layer one. Layer two, you are saying Article 181 subjects all forms of government borrowing to Parliament. And to the extent that treasury bills and domestic debt securities are forms of borrowing, they ought to necessarily go through Parliament. And that lack of synchronicity between the Public Financial Management Act, the BOG law, and the Constitution is what gives the executive the impetus to overborrow. So to correct that, you need to use a legal route to insist that all forms of borrowing go through Parliament. This is my summary of what you've said so far. Is that correct?
That's correct.
Good. Pause. Let me talk to the two guys on this point. Dr. Etienne, do you agree with the lawyer when he says that treasury bills and domestic debt securities should be given the same treatment as international loan transactions and borrowing from other financial institutions, to the extent that they are all borrowing, and to the extent that they can increase our debt stock and lead to macro instability? From a banker's perspective, do you agree with this point, or you see the need for the distinction?
No, I think he's right. You know, currently the government is borrowing on treasury bills as if tomorrow will never come. If we get up one morning and they will do the same thing like they did to the DDAP, what will happen to the economy? So what the lawyer is saying to me, we must make a clear distinction to tell them that these must go to Parliament for it to be approved. Other than that, if I have an appetite to spend and spend and spend, I may choose to submit budgets. You see, and like I think Professor said, or the lawyer said, in a country where nobody talks about expenditure controls, all these things that we are talking about, if we were a serious country who haven't achieved the Fiscal Responsibility Act 5% Act 982, I think we should not be talking about even this. We have suspended that act, and now people are spending and spending and spending and spending. The time we realize we'll be facing the same thing that we had with the domestic bond. So I cannot agree more than what the lawyer is trying to submit, because it's a very good argument. If we don't take care and you say that treasury bill is not included, I mean, you see the way they are borrowing. And when you borrow that, you crowd out the private sector. That is why banks are charging 30 and 50%. Because at the end of the day, they will have to take the risky business and you will take the easier business. That is why the banks are trying to do that. So for what the lawyer has said, for me, you should develop the argument and possibly seek for constitutional amendment, because it's a very, very important. The way they are going about treasury bills, I'm afraid we may have a similar thing with the bonds. So
okay,
I totally agree.
Let me pick Prof. Babwati on this. Prof, the litigant in me is saying, well, when it comes to international borrowing, Eurobonds and the rest of it, it goes through Parliament. But we are still in the red. We have borrowed in all those areas, right? So will it make a difference if treasury bills have to go through Parliament? Because all other forms of government borrowing goes through the same Parliament. And where we are is not a consequence of only treasury bills. It's actually a consequence of Eurobonds, more commercial kind of debts, which Parliament approves. So to what extent, what are you thinking around what the lawyers are saying in respect of this?
I'm not a lawyer, so it's very difficult for me to say what they are seeking to get is lawful. But it is important that whilst we have fiscal dominance when it comes to economic management, we also have executive dominance when it comes to our governance system. And if there's no checks, it becomes a problem. Yes, I agree with you that all foreign loans are supposed to go to Parliament, and all of them were passed, and we find ourselves here. If there's a way to add treasury bill rate, it doesn't spoil it. Maybe it will get to a point where Parliament will sit up and say enough is enough, and therefore we cannot continue to do our work as we've been doing, and therefore we have to put the brakes. Because if government, and for that matter, Minister of Finance can then determine how much they need to borrow from treasury bill at every point in time without recourse to Parliament or without any third person trying to oversee what they are doing, it will get to a point where it will be very difficult for private sector to get even a penny to even run their business. So if it is not in the law, I think it is something that we can seek amendment and then get it in. If it is the law, I think we need to activate it. We shouldn't say that we have gone that tangent before in terms of Eurobond. It has landed it here. We've learned our lessons today. And I think Parliament will now set up and say that we will not just go to the Eurobond and borrow anyhow without making sure that we put the brakes on it.
All right. We'll still come back and take solutions. So far, we've analyzed the problem very nicely. I will be back to ask my three guests what are their top two solutions in reversing this very negative trend of high interest rates, escalating exchange rate depreciation, and high inflation. Stay with us. Welcome back. The point of view tonight is looking at three escalating rates. Inflation rate, 25%. Exchange rate, CD selling or buying the $15 CDs, depreciation, very serious within the past month and a half. Of course, the lending rate also very, very high. My guest, Jonathan Amable, a private legal practitioner who has instructed his lawyers to actually go to the Supreme Court to seek interpretation that the Public Financial Management Act, sections of which I read, and the Bank of Ghana law are conflicting with the Constitution and therefore must be repealed to allow for all forms of government borrowing to go through Parliament. I also have Professor William Babuating, an economist, head of the Department of Economics in the University of Ghana, and Dr. Richmond Etuahine, a financial and banking consultant. So, lawyer Amable, let me just wrap up with you. So you are in court and you are seeking for what? Just summarize what your case is about and how you think it will change the way macroeconomic policy is done in Ghana.
The court case really is about, it's not even a constitutional, so when it comes to constitutional matters, constitutional litigation matters, there are enforcement matters and then there are interpretation matters. Interpretation matters are where the matter is not too clear or on its face, so you ask the court to interpret. But the court also has an enforcement jurisdiction, which is where the matter is very clear on its face, but something has been done in contravention of it, and so you're asking the court to enforce it. What we are doing is we are seeking for the court to enforce Article 1814 and to require that lending to the government through the issuance of domestic debt securities, be they treasury bills or treasury bonds, must be done subject to parliamentary approval of the terms and conditions of the transaction. And lending by the Bank of Ghana to the government under the Bank of Ghana Act is also done that way. So the relevant provisions of these acts, which fly in the face of the constitutional requirements, should be struck down. So these are the things that we are seeking, and I think they are quite important because in my practice as a finance lawyer, we realize that these things at the end of the day, especially when it comes to the capital markets, where we do a lot of work in the capital market, prevent our capital markets from being deep and prevent our capital markets from developing. Look, no matter how attractive an investment is, and we're talking about low productivity, we're talking about economic growth, and you need the private sector to grow. The private sector need access to capital to be able to do that. And if banking rates are high in the traditional banking sector, the various corporate institutions also have recourse to the capital markets. Casapreco just did a bond issuance at 26%, which is lower than the average that you've mentioned in relation to the banks. Now, one thing that is really inhibiting the growth of our capital markets is this issue of the government crowding out, because if you have a corporate institution that is seeking funds and comes to the market, everybody's looking at what are the risks involved in that and what are the returns that I can get if I'm lending on government bonds or I'm lending on treasury bills. Back then, the problem especially had to do with the bond. Now with the DDEP, the coupons on the bonds are lowered, and the focus is now on the treasury bills, which is seeing high rates. If these things are resolved, then the rates can be controlled, and it will give the private sector access to more capital so that they can do more, produce more, and actually help to boost economic development of the country. So that's for me is the focus. We have so many things that have come up now. You have the Ghana Stock Exchange, which has just come up with its what do you call that? It has come up with this commercial paper guidelines, which basically is a money market instrument that will enable corporates to raise money from the capital markets or the money market. And if they are competing with these high rates from the government, they are not able to raise the funds. The SEC has also come up with this crowdfunding guideline, which will enable, again, corporate institutions to raise funds. But if these are the rates that they are competing with, these things, although they are nice regulatory developments, will not be able to yield the needed results. So for us, the issue is to resolve that and then enable economic growth.
Thank you very much, Jonathan Amable, is a finance lawyer. Professor Babuateng, what are your top 1 or 2 solutions, particularly on the exchange rate? Because you said that was the most important of the 3. Can we salvage this? Because it's 15 to the dollar, and some are predicting it will get to even 20 by end of the year. Any proposed solutions?
Well, I think I'll try and put something there, but I don't know is the implementation that matters. So first and foremost, I think the structure of the economy, we have spoken about it a long time, import dependent. I don't want to go there because we know that we have to, as it were, export more and also reduce our imports. However, there are other things that go with it. So for instance, if we are talking about retention of forex proceeds outside, it doesn't matter how much you export, you will still not have the foreign currency hitting your domestic market. So in as much as we are looking at trying to restructure the production part of the economy, we have to also look at some of our regulations that allows exporters to retain a greater chunk of the money out there. And you see our trade balance being good, but you see our current account and our balance of payment suffering. The elephant in the room is the fiscal side. And the fiscal side, my main concern will be reduction or minimizing or eradication of wastage through procurement. I think if we are able to reduce all the wastages there, we will not come up to increase taxes that will also kill businesses, because it is about expenditure and revenue. But we seem to focus more on taxes and then we will kill businesses while we are wasting a lot of money on the expenditure side. And that is what scares me. We have just about 6 months to go to election. I don't know how government will be able to reduce or manage its expenditure so well that we will not be able to have any slippage. So if we are able to reduce the wastages, especially from the expenditure side, through procurement, then we'll be able to reduce the deficit quite well. I've spoken about the retention of forex proceeds, and I think it is important that the central bank takes a look at the fintech, that the remittances, which the fintech does, they have to try and take a second look at it so that monies that are given in terms of foreign currency out there also find themselves here in the domestic market, so that we can also increase supply of foreign currency. I have the other 2, which are long-term, and they are more regulatory. The first one is, I think as a country, we need to stop quoting transactions in foreign currency. And the government is corporate on that. I mean, when you go to Tema, they will tell you, oh, we are quoting it in cities, but it is benched against the dollar. And I think we need to take a second look at it, because if everybody knows that it's a dollar that we are benchmarking all our transactions, people will then move into dollars as a store of value, and that is an issue. And the other one is that this one is an advice to central bank. I don't know the forex guidelines, and I've said this before. Elsewhere, the forex bureaus are not there to trade in foreign currency. In other words, they are not to sell and buy. I would have loved that our forex law will rather mandate the forex bureaus to mop up the foreign currency. They are going to buy the foreign currency, but they are not going to sell. So they mop up the foreign currency on behalf of the central bank, on behalf of the banks. Because if the forex bureaus are mopping up foreign currency and they are also selling, it means that you have a lot of foreign currencies that will be outside the banking system and become very difficult to control. And in Ghana, I'm sure it is something that we all know. Many people have money, foreign currency stored in our pockets. And outside the banking system, if we are able to also look at that, at least we'll be able to slow down the depreciation.
Thank you.
Foreign currency.
Let me end with Dr. Richmond Tuahine. What are your top 1 or 2 solutions? I know you've written extensively about this, but for want of time, give us your top 2 most important.
I think 2 most top important is what the professor said, which is dear to my heart, very dear to my heart. Remittances. It is not only the fintech. Some of the newly licensed MTCs, the money transfer companies, are still holding foreign currencies. And that one, I think Bank of Ghana should revisit it, because it is in breach of the Foreign Exchange Act 723/2006. It says categorically, no person is expected to hold foreign currency except Bank of Ghana and the authorized dealer bank. And I don't know why the government and the central bank decided to ask for a new Payment Services and Systems Act 987, which has now empowered. Somebody came into this country for telecommunication. Now they are major players in remittances, and we all know it. And these are all affecting the depreciation of the city. So this is my short-term and medium-term approach, that government should sit down and let us revisit it, so that at least we can help the city that is running. And the last one, I think the monetary economic environment seriously need to be tackled if we want to make our businesses competitive and the banks to give a cheaper credit. I mean, you've forgotten in 2006. Bernard, you sit in your office, and at that time I was a GM on a bank. We sent people out to come and beg you to take money to buy car. At that time, the rate was about 12% or 11%. That was what we talk about, microeconomic stability. Not when inflation, when treasury, the rates are costing about 50%, 40%. Who wants to do that? Because anybody who takes money at that level, be sure he's not going to pay back. And that was the impact. That is what I would say for the time being.
Thank you so much. We've been speaking to the issue of Ghana's galloping rates from 3 perspectives. Our banker was Dr. Richmond Tuahine, a finance and banking consultant. We also had an economist, Professor William Babwating, who's head of Department for Economics, University of Ghana. And then we had the legal perspective from a financial lawyer, Jonathan Amable, who's a private legal practitioner, who's seeking for the Supreme Court to enforce its rules by declaring certain components of the Bank of Ghana law and the Public Financial Management Act unconstitutional, to allow for all government borrowings, including treasury bills, to be brought before Parliament. We hope this has increased your knowledge on the subject and added to the richness of the issue. Thanks for watching. We'll see you next time. Bye-bye.